It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, and joining me today, of course, smartest guy in the room, Michael Becker.
Hey, Paul.
Michael, as you know, has just under 5,000 apartment units in the Dallas-Fort Worth area, has over 300 unique investors that he's raised over $90 million with. So he is definitely the smartest guy in the room. And because he has so many units, we kind of call him Mayor of Becker Hills.
That's it.
So congratulations, Mr. Mayor.
Thank you.
So the question today for Ask Mike Monday is, Mike, what are you working on right now? Are you working on urban or suburban? And what do you like and why?
So yeah, we're still pretty active in both acquisitions and dispositions. As we sit right now, kind of middle of September, we have property we just refinanced. We have one property in escrow and a couple on the market. So we've been pretty busy on disposition, and then we have a couple more deals we're going to get done this year on acquisition. So I think we'll have probably done about the same, about 5 sales and 5 acquisitions this year. So probably do, 1,600 units. I got to tally it up, but something like that. So we're pretty active. We're still pretty bullish on the DFW market. Obviously, everything's a little tighter than it used to be. Everything's just a tough world out there, as I like to say. So just making sure we stay diligent in what we buy. But basically, I'm a suburban multifamily guy.
What does that mean?
Yeah, a lot of people have a niche, and they kind of, generally the most successful people just do one thing and they get really good at it and just repeat it. That's what I've observed. So we're suburban multifamily guys. So we're not going into the urban core. I'm not going into downtown. We definitely try to do our best to stay away from high crime areas, anything with super high density in the urban core. Many reasons for that. Typically the urban core tends to be, or at least through the cycles, where a lot of the new supply is coming in. So it's a little tougher, and then because you have a lot more competition that's coming in and being built right around you, so it's kind of putting some pressure on the rental rates on the urban core stuff. It's really some concessions that are having to give as these new properties lease up, and it's really kind of also muting some of the rental rate growth versus kind of going to the suburban areas. And then when we go to the suburban areas, we're looking for stuff that's near employment centers, near good retail, near highways, and certainly in the better school districts around town. Those are kind of what we're looking for. Some of the things that we like about we're typically now, when we started out, we're really definitely doing kind of the C-class apartments. And we're pretty much out of that business now. What my company focus on, SPI Advisor, what we focus on is kind of B to A minus is what I would call it. So think, generally speaking, 1985 to 2005 construction in DFW. That's about that 20-year window is kind of what we're looking for. The last thing we bought was in 1984, and we're working on right now a 2008 vintage. So, kind of plus minus a little bit, but generally speaking, kind of anything from pre-recession back to the mid-80s are what we're looking for. And why do we like that? We think there's less supply. All the new supply is being built in DFW, and I think across most major cities, we're buying in areas where it's already pretty well built out. There's not a whole threat of new supply that's going to directly come in and compete with us, because they're going, in Dallas, for example, they're going to the northern suburbs of Collin County, so like Plano and Frisco and McKinney, and we're buying in, North Dallas, which is pretty well developed. So we're, what we focus on, we have a bunch of stuff kind of in the far North Dallas, which, was kind of when the 80s ended and a lot of the big supply was put on of the B class product. We're about as far north as we can, and so we're kind of supportive, and we get derivative play of all the growth to the north when they're kind of the people that go support all these high paying jobs to the north will come down and lease with us. Another thing we're doing is we're kind of going a little bit west, so we're kind of going more towards Fort Worth and Tarrant County, because there's a lot less supply being delivered in Tarrant County. We're pretty bullish because as a percentage, the rental rate growth and population growth is a little bit higher on that side than it is on the Dallas side. So those are some of the things that, whether you're in Dallas or not, you kind of look at your metropolitan area that you want to invest in and just try to focus on stuff that is, a little bit away from the supply that's being built, and try to just really be smart about how you pick your locations and the prospects of future growth. So those are some things that we think about.
I would probably imagine, suburban properties that the community of people, they want to live in the suburban properties just because, better schools, less crime type of stuff, instead of being into some of the C-class properties or C- class properties where they almost have to be there. They need to be there just because of the income that they generate for rents. So that's good for you guys. But tell me a little bit about what's going on. If someone didn't have the experience level like you have, Mike, they want to start out. I mean, would you recommend going into some of these urban areas, older properties, or would you recommend saving some money and getting something newer?
Yeah, I mean, I don't think there's anything wrong with it. I mean, you just got to understand what you're buying and make sure that you have the right, in particular, the right management team in place that can handle the asset that you're buying. I mean, the one thing that we always pound the table on is don't buy in the hood. So it's just certainly cautious in everyone. Make sure you run crime stats on all your properties. Make sure you understand, what you're getting into from a crime standpoint, and that there's actual employment drivers and people that can work near where your apartment's located. Because if there's no jobs and, trying to get rent is going to be hard, in particular in a down cycle. That'd be the one thing I caution. But, the smaller properties are generally kind of the older urban core areas. That's where a lot of people start, and then they kind of graduate up after they've got to kind of their feet wet in a smaller property, and they kind of move up. There are several pockets in DFW and surely in most major metropolitan areas in the suburban that you can find kind of Class C stuff that is smaller or a little bit older that is generally a little bit more affordable on a price per door. So I don't think there's anything wrong with that, Paul. Just you need to make sure they understand what they're getting into, and they surround themselves with the right team that can actually handle and manage that. And if they do that, then that's a large part of being successful in this business.
Yeah, I think people are attracted to those workforce housing areas because of just price points, and sometimes they get brought down the rabbit hole because they think it's so cheap to buy it that it's going to be operated cheaply too. And you've had lots of experience in kind of figuring out these older 1960s and 70s properties. They're not that cheap to run.
Yeah, like what I like to, the analogy I say a lot to people that I talk to is one of the main reasons why we've kind of moved up in the asset chain, besides our ability to attract more capital, so you can just buy bigger deals. But more than anything, these properties on paper, I see a lot of these older 60s and 70s vintage deals that have cast iron sewers and wood siding and flat roofs and asphalt parking lots and maybe even a chiller and boiler system. They come in pretty well capitalized. They cure all the deferred maintenance, make sure all the major components are working. Then over a period of 3, 4, 5 years, this rehab that you just did starts wearing out, and you have all what I like to call these non-recurring expenses that recur all the time.
Yep.
So these newer properties have PVC sewers that don't necessarily degrade, where the old cast iron sewers, the bottoms kind of rust out. So these old properties will have a $10,000 sewer line backup they have to dig up and replace the section line, and that goes down below the NOI line in CapEx. So it doesn't look like it actually impacts NOI, but it's actual real cash expenditure. Or, you have an asphalt parking lot that you go patch and resurface, and then 2-3 years later, it looks like crap, and you got to patch and resurface again, and you're spending $30,000 or $40,000, depending on the size of it, to do that. Or if you have a concrete parking lot, it's a lot less maintenance, and you do minor patching here and there, but you don't have to completely resurface it. So those are some of the things that are hidden down below the NOI line that if you own these deals for any long period of time, they might not actually impact your NOI, but actually impacts your actual cash that you can, you have to pay out, and potentially, your cash returns to your investors.
Listen to Michael Becker, smartest guy in the room when it comes to operating and owning multifamily properties. You'll have a chance to meet Michael if you would want at the Old Capitol Multifamily Conference on October 5th. Michael, tell us a little bit about what kind of capacity are you going to be in that conference with?
Yeah, so I'll be hosting the broker panel. So that's one panel. Another panel that we have, I think we're going to have management companies up there. And who's hosting that one? Is that James Ng?
Yeah, James is going to be hosting that.
So James, you hear on the podcast a bunch. So James will be hosting the management company panel. We'll have 4 or 5 management companies here locally that focus on B and C properties. We'll have Wayner Multifamily, who does a bunch of C properties. We'll have Ally that does a bunch of smaller properties. Citygate that does the kind of the B and C, a little bit larger properties, and then SIMC, which is a management company that I use. I kind of do B. They do some C, but mainly B to kind of A product is what they manage locally. So you kind of get a little flavor of different size management companies, as well as management companies that specialize in different asset classes.
My favorite part of this conference is going to be kind of talking a little bit about past deals, and we're going to have a couple managing members that had gone out, purchased multifamily properties. They raised a bunch of money through a small syndication. They did a full cycle, which means they bought it, they operated the property after they did some rehab, and then they either sold it or refinanced and pulled some cash out. So you're going to listen to some case studies And you're going to hear from some limited partners about why they invested into some deals. So we're going to have a little open floor discussion about why limited partners get into these transactions, what they're looking for, what sells them on the managing member. So we're going to, take it down a little bit. We're going to talk a little bit about why people do stuff. And so use that information about when you are going out to do your own deal to kind of figure out what works and what doesn't work.
That's right. Yeah. And we just signed up a new keynote speaker, Paul. Maybe talk about him a little bit.
We've mentioned it, but I want to have you take it to heart is that, these transactions are not done in silos. They are done as team members, all participating all as a group to try to acquire, manage, operate a property. And so the guy that we brought in, I thought is going to tell a great story, is a guy named Rob O'Neill. Rob O'Neill, he is the guy who shot and killed Osama bin Laden, and he just didn't do it by himself. He had a bunch of team members, qualified SEAL Team 6, to kind of help him get him to Pakistan and do his stuff. So we're excited to have him talk a little bit about team building and never quit, but commit. So commit to be successful, whatever you do. So he's going to be interesting. We do appreciate you if you could come to that conference. I think we have like 30 or 35 tickets remaining. You do want to come to that conference and listen to him. So
how do they sign up for that conference, Paul?
Go oldcapitalpodcast.com, oldcapitalpodcast.com. Go to our website, click on the right-hand side. You'll be able to get the tickets to that. It's in Dallas. It's at the Addison Convention Center. So it's going to be worth your time to listen to what's going on in multifamily.
And it's a great networking event. A lot of other owners will be in town, as well as the brokers that control most of the deals and management companies and certain other service providers and lenders. So if you're trying to figure out how to get this business, this is a good way to shortcut building your team out. So definitely appreciate everyone listening to this. If you guys like it, refer a friend. We'll certainly appreciate if you guys let some other people know if you think they could get some value out of this. If anyone's an aspiring apartment investor, we certainly appreciate that, as well as a rating in iTunes or Stitcher would certainly help.
That's perfect. I'm Paul Peebles, smartest guy in the room, Michael Becker. Have a great day.